It's a great problem for AI as long as you convince the people who are risking their own capital your AI got it right.
Hello, everyone, and welcome back to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
We're always happy to partner with people to bring you these smart conversations. And in fact, we have open partnerships right now. And so if you're interested in sponsoring one of our shows, please email us at podcast@thehousinginsiders.com.
And if you like the show, give us the review, spread the word, because that's how we can keep making these podcast episodes for you.
All right, we have a pretty awesome episode today, and it's awesome for a lot of reasons. And I'm going to try to list them. First and foremost, it's awesome because I'm not feeling well, which is awesome. And secondly, Jeremy and I are both in Washington, D.C. right now, so we're in a really beautiful, awesome studio. We also have glasses of whiskey, which Jeremy's going to talk about. But most importantly, we have two of our very close friends who are really amazing. I'm really excited to talk to them. Been wanting to get them on the show for a while. We just so happen to have them both in the studio today. I'm going to ask them to introduce themselves, but I'm going to start with Nate. Nate, tell us about yourself, what you do.
Yeah, hey, I'm Nate. I'm founder and CEO of Ardley Technologies, and we are a software company that helps mortgage servicers make the most of their recapture and retention play in their portfolio. So the way we do that is by finding deals that they're probably not taking advantage of, and then we have some great technology that puts them in front of their borrowers, and then we have a customer experience that can bring them all the way through the loan application process.
It's an amazing technology. We're going to talk a ton about it, but I should also mention that Nate spent some years in service at Fannie Mae. So clearly he's a wise man I'm glad we don't have video. Patrick, you want to introduce yourself?
Yeah, sure. Patrick Gardner, Vellum Mortgage. We are I guess we're not a regional IMB anymore. We were in the DC metro area for a while, and then we're out in California and Texas now. I'm one of three founders and two principals. So me and one other person run the company. And we've been in business since 18, I guess.
Awesome. And then, Jeremy, maybe you can introduce the whiskey that's going to fuel the episode.
That's joining us.
So everyone understands why this episode will slowly deteriorate across the next hour.
Well, if it does, it will be because of Horse Soldier Bourbon. We picked this up because I had attended an event where the founders of Horse Soldier Bourbon are the soldiers on 9/11 who went into Afghanistan on horseback, and they were the first 4 soldiers in on the evening of 9/11. They spent many tours together, and they have stories about that. But when they all retired from service, they opened a brewery, or a distillery rather. And so they have a brew house tasting room in Tampa, and they have the distillery in Kentucky. And so Horse Soldier Bourbon has several different layers, but I got to meet them at an event. So I'm a big fan. And so I keep coming back to it for that. It also tastes great. And the last thing I'll mention is their high-end bottle, not the bottle we're drinking, but the high-end bottle actually has metal from the World Trade Centers as the plaque on the front of the bottle if you collect that or would be interested in it. So true American heroes and really cool guys to hear from about their experience as well as their business. So we supported them today.
It's fantastic. And as I'm drinking it, my cold is slowly retreating. So this is great.
So it's working on many levels. And hopefully it'll be some honesty from everybody.
No chance. Actually, as a relevant tangent, I have a bourbon story with Nate. So Nate and I have known each other for a long time.
Keep in mind, my wife's going to listen to this episode.
No, it's a compliment.
Okay.
And early on, so for those that don't know, Nate actually worked with Vellum for quite some time while building out Ardley. And we went to some sort of, maybe it was an MBA happy hour at RPM downtown. And we're there. I'm just introducing Nate to our team. And we get up to leave. And I'm like, Nate, we're going to take off. I was like, what are you going to do? He's like, they have free bourbon. I think I'm going to stay. And I walked out and I was like, that's our guy. Everyone's like, yep, he's one of us.
Yeah.
So, those little things, Nate doesn't really know that, but we were like, yeah, he fits.
Yeah. So say more about that. So was he working 2 jobs at the same time for Vellum? Was he incubated within Vellum? Talk about how Nate thought of it at the time, how you thought of it. How did that work even?
Yeah. So it actually goes back further. Nate and I were introduced by someone at the bank that owned our prior mortgage company. And he was still at Fannie. and he was tinkering with this idea of the software. We got connected and we just would chat about it every once in a while, no regular cadence or anything. But, he was kind of building it out. I would try to give him as much input as I could. Obviously, I'm not a super tech savvy guy, but when Vellum started, I think he was kind of at that point. I don't want to speak for him. He was kind of itching. Maybe I should do this. And I sat down and I said, okay, why don't you become the CTO of Vellum? But I only want you part-time. We're a small company. We're just getting started. But I kind of want your brain, right? You're super smart with the tech. You understand how the GSEs want us to operate. You have your own ideas. And then we will give you our expertise on the mortgage side. And hopefully that will help you build out Ardley. We would try to use Ardley if we could. He would help us build some things. And that's how it started.
What was your experience, Nate?
I really appreciated the help during that time. I mean, I'd been at Fannie Mae for 16 years and was leaving to start my own software company. I mean, it was pretty terrifying. I was a creature of the of the huge GSE institution, and I was heading out on my own, and to be able to have Patrick to bounce ideas off of, and I was able to get insurance through them, and it just really created a soft landing and a way to get going. And I really appreciate it. I still do. So yeah, thanks.
Yeah, it worked well. I mean, we were able to do some things that tiny little companies shouldn't do, right? Through either Nate's network or his speed of being able to do things. He already had the knowledge. So it worked out really well for us. And I think it's, we've continued to stay in close touch.
I think it's interesting. A lot of companies want to become innovators. And so they'll create a team that they separate aside to be innovators. But this is you found a founder who was clearly innovative, knew what he was doing, brought him in partially to kind of incubate a new product, which I think that's it's a cool model that it's the only time I've ever heard of a model like that. And I think other companies should really consider it. So Nate, can you tell the Ardley story a little bit? What was the software that you initially envisioned? And I know you've had to make some pivots, as everybody in this industry has had over the last few years, but yeah, give us the backstory.
Yeah, sure. So I originally started the company thinking that I would be able to outcompete the other point of sale systems out there. It was really, at that time, I was at the tail end of a lot of investment from, originally Peter Thiel invested in Blend, and then there was Cloud Verga and Be Smarty and some other ones out there that people were trying to do. And I thought that I could come out there with a better, faster, cheaper one. I tried my best, and I thought because I could write my own code and I knew a thing or two about mortgage originations that I could do something that was maybe more cost effective and, maybe get it out there a little more cheaply and easily than somebody else. And I, was grateful for Patrick's help and then wanted to try to make that happen.
By the way, that's the way a lot of founder stories start.
Yeah.
It's not the way they end.
Well, yeah. And so I think the thing that I sort of had to come to terms with was, and I needed some other hooks on something beyond just taking a mortgage application that I thought would make it better. So we were trying for a while. Patrick and I would talk about, hey, we should put MLS stuff in there. We should try to make it a really easy experience for people. And what I wound up hitting on was actually hanging around with a couple of the LOs and processors at Vellum one day. I was hearing about when it comes to the doing like a purchase or a refinance, there's a step in the process where you have to call the current servicer in order to get the payoff amount in order to do the loan. It's like, oh, tell me more about that. Like that's pretty interesting. I mean, I didn't know that much about servicing at the time, but I knew servicers treated that as an asset and didn't like like getting those phone calls, right? And then somebody from Patrick's team has to call and make that happen, and that is essentially a signal that servicer is going to lose that part of their portfolio, that one loan. And so I started thinking more about that, and I was like, well, I started talking to Patrick about it too, and the people in his office, and it was kind of like, well, how come the servicer doesn't do a better job keeping that phone call from happening? I mean, if they were able to find that person ahead of time before one of his loan officers had been able to get in touch with them, they'd be able to do that refinance. I mean, clearly there's easy ways. And the other thing, I was like, well, if they are the ones that calculate the payoff amount, that means they have a lot of other data, like what was the origination credit characteristics and what's the current loan balance. What are the taxes and insurance? What are the, things that, and so I started looking into it, and I was really surprised by how much data the servicers had. But, apart from some of the largest, most sophisticated servicers, I didn't see a lot of people trying to take advantage of that data in the way that I thought they could. We had a point of sale, and I thought to myself, well, if you can do a lot of the work that loan officer was doing when they were about to call and get the payoff amount to do the loan, what if you could proactively do that work on behalf of the servicer and put the deal in front of that borrower ahead of time? Like maybe you could help them protect that portfolio. And, instead of, a lot of the servicers will call it portfolio defense or recapture defense or things like that. And I was kind of like, well, why don't we just make it offense? And so since we already had the point of sale, I thought, well, we could pre-fill it with all the data that the servicing portfolio has, plus all the data from the deal that we just did the math on, and maybe we can put it in front of that person. So my hook eventually became, well, so it's a point of sale, but it's a point of sale for servicers who are trying to do that recapture. So that was kind of the way we got started, and we were able to go out and find, frankly, a larger servicer than I thought we'd be able to find, to be the first person to do that. And we targeted some of the government loans that are really easy to do. So like your VA IRRRLs and your FHA streamlines are, for maybe people don't know, but those loans don't require a credit check or an appraisal even, which are two of the really big tripping points in the loan process for a conventional loan. I mean, that guy who's getting the loan may not be able to get it because the FICO score could be low. Well, they don't even have to check that for the VA IRRRL and our FHA streamline. And then, deals fall apart over the appraisal not coming in at the right number, but that's not a problem either. So the idea was to try to create as much of a streamlined product for those government loans and try to help people get those loans more easily. And so that was the original point of what we did. I don't know if that's a pivot or not. I mean, Slack started out as a gaming company and then turned into like the messaging, I mean, I don't know. So, but within the same industry, the idea was, hey, like I'm going to help people fill out their own mortgage applications. And then it became, well, servicers have all the data that you need. So we're just going to go from there. So that was,
the bitter irony of all this is we've had a small kind of refi pop right now, and the servicers they're so good now.
They're ahead of everybody.
Yeah, it's really, IMBs used to capture that market substantially. Servicers, either it was a logistics issue, right? They just didn't have the people in place, or but they've got their tech stacks rolling. I guess too many of them are using Ardley, which is ironically very annoying.
So there are some
tough.
out there, maybe that you have sold to in the past. So yeah, it's possible.
Fair enough.
So it seems like, Patrick, the threat is that in the meantime, while Nate was building Ardley, all of these servicers either found an originator or found the technology they needed to connect to that real-time pricing, real-time offer, real-time lead management. And what you're saying is between then and now, you're getting speed to that homeowner, and they're getting maybe not even a better offer. They're just getting an earlier offer from their existing servicer. Is that the threat?
Yeah, sometimes. So it's, I mean, I'll go through the facets I can think of right now. So that is one possibility, right? They're constantly scraping their servicing pipeline, but we should be doing the same thing. So I would argue a loan originator should know his past clients deeply, and most do, right? And so on one hand, we have probably a better established relationship. Servicing is not a deep relationship. If you go online, servicing rankings all tank. I mean, you could probably be a great servicer and you've got the worst rating because just nothing good comes from servicing from a consumer perspective.
Built is deployed at all the servicers.
Yeah,
right?
TBD, right? All right, fair enough. So on that aspect, I don't know that it's speed, but regardless, the trigger lead bill obviously exempts current servicers. So really what happens is they get triggered. Even if you soft pull and wait, they're so ready that if they haven't captured the client, at some point you do hard pull that credit, or you do request the payoff, even if you wait, if you're strategic, and they can move. They literally can turn around and just say, hey, this is about to leave our servicing portfolio. There's an inherent cost, right? It's a reduction in the value of the MSR. And so they will come in with a really sharp deal because it's a complete loss otherwise. And so that's the hard part. They were never as quick to respond. So we had speed at the IMB level that they could never catch up to, but that's not the case anymore.
So I mean, it's a lot of the servicing is consolidated, the technology is improved, AI is only going to make that better. It's still interesting, and Nate, you talk about this a lot, how servicers can't really connect their servicing data with the origination side. I imagine it's one thing during a refi boom, but another thing during sort of regular purchase market, which was the one thing that we've talked about with Ardley, is this idea of how do you capture turnover when somebody's just deciding to buy a new home. And you guys have started thinking through, again, I see this as a small pivot. If you're not in a refi market, you've got to figure out how to capture repeat purchases. And you guys have done some interesting things in that space as well, right?
Yeah, that's true. It's genius me, right? Like I graduated in 2001 with a computer science degree when the .com bubble was bursting. And then I finished my MBA in 2008. I was like, oh, I'll go into investment banking. Well, that didn't.
You need to go into AI real quick then.
Seriously. And then, I start my mortgage company, and then, like we get VA IRRRLs out there, and then rates jacked up, and we've had to grow in an environment where it's been very tough. And certainly purchase has been, a really big challenge for all the servicers out there. And the way I know that it's a really big challenge for all the servicers is, I don't want to be diplomatic here because a lot of these people are my customers or my potential customers, but you'll get all over the place people telling you, oh, my recapture rate's 99%, for refis or whatever, which it isn't, by the way. If anybody's listening to this, it's not, but they'll tell you, they'll find a way to massage the numbers to say that. And but no one even tries to say they're good at purchase recapture. Like every single place I talk to, of all the names, everybody, is always like, what do you have? That's great that you have these recapture plays, but like, what have you got to try to get, the purchase leads? Cause that we can see that runoff, and we're just terrible at it. So, yeah, we do have some stuff for that. I would say the other thing that we've really tried to focus on is second mortgages. So like everybody out there really has two portfolios right now, right? You've got a bunch of people, if you're a servicer, you've got a bunch of people that are at 3.5%, 4%. And they're not eligible for a rate term refi, and a cash out refi looks like too high of a number in terms of the rate if you're going from 4 to 7 or whatever it is. And then there's a lot of people that are originated in the last 24 months that they have rates that are way more sensitive to rate terms. So what we've tried to do when we go to a servicer now is say, look, we can help you do both kinds of loans, because you're not going to get, there's no, those rate term refis are not coming from that kind of 2/3 of your portfolio that's so low, but you can give them second mortgages, and you can engage them in a way that if they want whatever it is, a new deck or bathroom or whatever people do with home equity loans. And then, there'll be a moment in the not too distant future where rates could drop to a point where you could actually say to them, well, your first mortgage is at 3.5, your second mortgage is at 9 or whatever it is. We can help you with a full-on cash-out refi that can actually blend those two and lower the payment for you. And so, we try to say to servicers, the reason you want to have our analytics and our quick outreach always on is because there's always something to do with these people, even if you haven't considered second mortgages before. That's not really a big part of your business or whatever it is. So yeah, that's purchase is obviously something that we are talking to our customers about a lot, and we have something rolling out later this year that I think will be even more advanced than what we have now. The idea that you can sell quickly and pivot to whatever is working in your portfolio is part of also what we are trying to help people do.
I think the unique thing too is like the refi, it's math. I either need money, the cash out version that Nate was talking about, or I would just want to know what is the amount I'll save and is that worth it to me? On the purchase in the second, it's actually much more contextual. Like there's contextual things happening. There's life events happening. Can I buy a house? Will I buy a second house? Upsize, downsize, all these different things. And the second is, what am I using it for? On what time frame? So the biggest thing that we were bad at for a really long time, and this includes like purchase recapture, if that was even a thing at Rocket, which it really wasn't because it was as bad as you've described, was how do you give people the deal or the scenario and let them play with it, figure it out, think about it without losing that lead. That was a really hard challenge, because as soon as you let them off the phone, you're afraid you lost the deal. So how you bring technology, visibility, or some sort of ability for people to say, oh, that's what that would do. If I change this, and they're not on the phone with a very expensive resource, the loan officer, walking it through, which is kind of how we talk through these things usually in the industry. Now it seems like that's changing. I don't know if partly due to Ardley, and the reality is like, how do you keep them, let them play with the scenarios, but not lose the lead? That is a really tough challenge and an expensive challenge.
Well, Rocket's model is just to call every 15 minutes. Come on.
Right, that's right.
It's
just call.
We used to run tests on that.
Did you?
Yeah, we'd all half apply. Oh my gosh, it's amazing. I've never received so many phone calls in my life. So you're the opposite, right? So Rocket's the opposite. It used to be a logistics issue servicers would never call. No. They're on it.
It's instant.
It works.
I know. I mean, it's within minutes.
Yeah.
It's pretty amazing.
Yeah, I mean, all these lead places, Zillow, for example, you start filling out a request. I mean, you're going to get a call in seconds. It's going to be a high quality person that's going to know how to keep you on the phone and move you down the pipeline.
So as an anecdote to that, this actually was happening for a while when we were still automatically doing hard pull credit as part of the online loan application. We found on not a high percentage, obviously, but just any percentage, borrowers were actually getting called before they were even done completing the app, and they were getting confused because whoever was calling them was not being clear who they were calling from. So we had people thinking it was Vellum, and literally they were like, oh, we can finish up your app. Hold on, this didn't come through, and just confusing them into another application. It was wild.
I can be whoever you want me to be.
Yeah,
baby. You want me to be from Vellum? I'm from Vellum.
So, and remember
when
you pull credit, it does typically say where it comes from, right? So, not always. So they do have some information, and for us that was wild. So we obviously flipped to the soft on that because
sure,
you're losing borrowers for no reason, right?
Can I take the bait and pull us up to that brand level for a second? So that to me it's a tough problem for you. You have high producing, almost celebrities in their community loan officers, and then you have your brand, the name Vellum. So the hard pull is Vellum, and even when it's soft pull, the person wants to know the company they're working with, and they want to know that it's reputable and it's real. But it's the person that has a lot of that credibility and who they're working with. So you could tell somebody you're working with Vellum, and they'll be like, no, I'm working with Jim or whomever. Can you talk about, as an owner, as the founder, as the operator, but knowing that you're fighting for these guys and men and women every day that are selling for you, how do you think about it? Vellum versus Jim or Sue or whoever?
So I actually look at it a little differently. IMBs, if you have retail loan officers, right? We work for them. Okay. We work for the loan officer. The company tries to put together the best platform, the best people, the best brand. Obviously, if you inherently have a terrible name on the street, you're better having no name than obviously a terrible name. But really the loan officers, and particularly our loan officers, they have a phenomenal name with their actual name, right? The way I look at it is, we recruit them to us. We let them know how we operate, the things we do well. And at the end of the day, we're working for them. I'm going to them and saying, hey, what provides your customer the best experience? Because they typically know, right? And so inherently, that's great for our consumer. It's great for our borrower. And it's great for the LO. What makes your life easier?
Mm-hmm.
What makes you perform better? And these are the things. And so, the three founders of Vellum, we're all loan officers, right? So inherently, we had a good base knowledge of what we wanted. But that's just kind of how I've had to learn to view it, right? It's kind of like a loan officer should be a 1099, but they're not. They're a W-2, right? Like a realtor is kind of a 1099, self-employed, but it acts a lot like that.
Tell us the Vellum story, because one thing as an aside, I mean, Fannie and Freddie have been excited to do pilots with you. I sort of feel like while you're not on the cutting edge of like AI technology, you're on the cutting edge of like smart originating. And you the loan officer situation is what it is. And it sounds like you're similar to most in that you're sort of relying on people on the street as your distribution. You're not buying Super Bowl ads, and that's not your sort of claim to fame. But talk about Vellum.
Not yet.
Not yet.
Yeah.
Fair.
We're going to have a stadium soon. High school.
Talk about how you view the business and what you wanted to do coming as a loan officer to starting Vellum.
We had three founders of Vellum, all with great experience. The piece that really was near and dear to me was operations, right? And how we we looked at the loan manufacturing process, for lack of a better word. So one of the things Vellum did that was key, we did not go into Vellum and say, oh, we're going to tell loan officers how they have to sell. That doesn't work. Loan officers inherently have their own style. They're typically very good, and that style can range dramatically. One of the key examples being the other principal, Jay, was fundamentally different for me from a loan officer. Very successful, but stylistically completely different. I was more operational. I could never walk into a room and, glad hand everyone, and that just is not my style.
Jay almost sold me a loan like 4 times
Yeah.
while I was working there.
Exactly.
Like, yes, beautiful.
And that's my point. So
I'd like to meet this Jay.
yeah.
Well, not if you don't want a loan. I mean,
But so the way I looked at it is I felt that the process was relatively the same at every company I'd worked at. I had moved around to a number of companies, and so I wanted to change how a loan was done. And so at most companies, you have some version of loan officer, maybe a loan officer assistant, a processor, an underwriter, and then on to closing. And so I really wanted to touch sort of the processing loan officer assistant piece. It's an expensive piece. It's a piece that, when you look at the Venn diagram, it overlaps way too much, more than it should. At the end of the day, that's how it ends up working. And so we don't have processors at Vellum. We don't have loan officer assistants. I spent a lot of time breaking apart the mortgage process top to bottom. I literally itemized every single thing you had to do a loan. And then what really kind of came out is it's an enormously task-based, highly organized job, right? And then you have the consumer facing piece. And so having the person that has to be wonderfully consumer facing and task based and highly organized, that's a tough skill set, right? They usually don't cross over very well. So we broke it apart, and we created a team for all the task based, all of the file maintenance, all of the monitoring, all of the pipeline management. And that team focused on that basically nonstop. And then we created a single point of contact that we call loan manager for the consumer. So outside of the loan officer, the borrower has one point of contact at Vellum, and it will guide them through the entire process. So there's no handing the file off over and over again. And we think that is a better experience. It provides unbelievable speed. So during COVID, when people were on 3, 4, 5 month turn times, we were we averaged 24 days, and most of that was due to title company. Our processing turn time was 3.5 business hours all through COVID. And there was one point we actually thought about opening a consumer direct because we had so much slack in our system. We were like this. So it was a good proof of concept, right? So for us, it was, hey, how can we make life easier? And we feel that it works really well for very strong loan officers. They come in the door and say, hey, I can really work within this model because you guys are just cranking through the loans. It's very systematized. I know what I'm going to get every time. At the end of the day, I think originators want consistency. Even if you have a few bumps in the road, as long as they know where that bump is every single time, they know how to work around it. They're salespeople, right? They're phenomenal at this. And so it's the inconsistency where they don't know what's going to deliver that drives them insane. So that we just highly systematized it, and we got a ton of speed, a ton of throughput, and it's worked really well for us.
Do you see that your recruiting then ends up being like word of mouth among loan officers? Do you have to have a recruiter? Are you the recruiter? What ends up happening then to like continue to grow? You said Texas, I think in California, and you've now grown. How's that happening?
Yeah, so that's actually a pretty good story. So that's a team. That's a single team for us, and they operate under a DBA, JVM lending, and basically we went to them to talk to them about how their model worked, and we just sat down, and at the end of the day, we thought so similarly about the process. They were struggling as is. They were considering leaving, but in a way, we probably had no business bringing on someone that size. At the time, they were of equal size during COVID. We were essentially going to double in size with them. We had never touched California. We'd never touched Texas and these states. It was all new to us. I'm not afraid of geographical expansion. I just think you just learn the laws of the state. That's not a big concern to me. It's just, is it the right fit? And so in that case, absolutely. They just looked at our model and said, yes, you guys think like we do. These are the things we want to do. These are the avenues we want to head down with tech or file flow or something of that nature. And so that worked out well. Now the other side of it is it's a very different world right now. I mean, your file flow, it's hard to articulate that to a single loan officer and what does it mean to their business. They're looking for, unfortunately, the balance sheet is a big deal right now. There's a lot of money out there, a lot of big companies. I think a lot of people were concerned for a few years there about size, but we obviously did quite well. We outperformed every year. But it's still a beast, right? Educating someone to let them know that process is so beneficial to the business is not an easy thing. But we have a head of sales, Greg Kingsbury. He's phenomenal, one of the top producers in the area, has a great reputation. So that goes a long way.
So I'm going to pivot a little bit, but I just want to, before I do, Patrick and Vellum have been amazing educators for me at points in time in history. Obviously, with Nate having spent some time there as he was incubating Ardley. Ardley's an incredible company. So these two guys have some really amazing businesses that they've been thinking through. I kind of want to ask a couple general questions, and maybe we'll talk a little bit about where the market is today. But I want to start with one that always bugs me, and I know it bugs you guys, which is I've talked to so many founders who basically come and say, well, the reason nobody can do a digital mortgage is because nobody's doing it right. Like they've got to figure out how to change the process. And if you change the process, you'll have figured out that it's really possible to do the perfect loan every time without requiring an immense amount of human bodies to throw at the problem. You guys have taught me that that's wrong, but I want to talk about that misunderstanding. And then I want to talk to all those ambitious founders out there about like what do some of these situations look like? Why do they arise? What's the underlying problem with this industry that we can't make a process which feels like it should be fairly digitizable, but it's just not?
I'll start with a quick story because it goes back to Ardley and Nate starting at Vellum. So that was literally the basis of all of our conversations and really every argument we ever had was, how does this work, right? And Nate had an idea. He was like, I'm going to come in and really I can essentially do everything the loan officer does. And I was like, good luck, right? But there is, obviously I had a belief in the software because there's a lot it can do. And so it's a bit of a pendulum, right? As certain things improve, yes, it can take on more and more business. But the reality is it's still more complex than anyone ever thinks, right? We're not just originating loans, but we're placing those loans to all sorts of different places. And so do they adhere to the data? And then it sells up into pools, into those pools. And so it's just this, you have to have so many parties involved to truly do a full digital mortgage. And it's just not as simple. A very, very basic, and it's not really related to what Nate and I worked on, but even e-notes for a while were so complicated because no one really wanted to take them but the agencies, and the agencies wouldn't pay for them. And so we'd have to sacrifice a huge amount of margin. So it's like, well, why would we do this? So it had nothing to do with the process, had nothing to do, we had to sacrifice dollars. And, post-COVID, that's there weren't many of those floating around. Right. So it's right. That's just an avenue you don't even think about. You think it's like, the consumer doesn't want to adopt it or something like that. So, there are lots of reasons probably why the digital mortgage doesn't work. I think Nate probably has a better understanding of the technology side. I could tell you about probably the people side of it.
I'd love to hear about the people side of it. I've been humbled over the course of my career. I came out of Fannie Mae thinking, I've worked on desktop underwriter. Like I understand how this works. Like I know all the nuances of the gift letter, so I'll be able to figure it out. Like this is going to be no problem. And I don't know. One of my main criticisms of a lot of the people that are out there selling software to people like Patrick who are doing loans in the real world is I think an awful lot of the stuff that people sell doesn't really deliver on the cost benefit that they say is going to be there. And I mean, my data is a little old, but when I was first looking at the statistics from the Day One Certainty program, when I was at Fannie Mae, I mean, I don't think this is a trade secret or anything. There weren't that many loans. Like, you could measure them in basis points that were like going through the process that everybody had envisioned, for the fully digital slam dunk mortgage that went from start to finish, and the borrower filled out their own loan application, they connected to their bank account, and voila, like there was no problems. I don't have all the most recent data, but I would be willing to bet quite a bit of money that if you dug into GSE data about how many loans rocket right through the system without any, if they get income, asset, and employment and valuation relief, I still think that's probably measured in basis points. And so I think it's confusing, because if you wanted to buy 5 shares of Apple stock right now, like, it's kind of unimaginable to you to call your broker, right? Call your broker. No. You can download Robinhood and
do it.
You can have it right now. So I don't know why this industry has been so impervious to some of the advancements that other industries have seen. I think, I've really tried. And like, I even kind of talked to you before about, we do the loan, we do every kind of loan at Ardley. We can do non-QM, we can do agency, but the truth is, like, the Govy loans that are like VARLs and FHA streamlines are great. And all the other stuff is like, there's always some snag. There's always somebody's got alimony. Somebody's got something that's got to be documented, or, forget about self-employed borrowers. The whole thing is still very difficult. And I don't know. I don't mean to criticize my fellow founders that are out there. I always try to say, like, I'll let you get to it in a second, Patrick, because I want to hear what you have to say. But like, when I was starting this business, like, one of the questions my wife had was like, why, like, don't you get worried about, like, I don't know, like some 25-year-old product manager from Google, like, coming out? And I was like, that's the least of my worries. Like, right. I think this industry is a little bit impervious to that sort of profile. Like, you have to spend a couple decades getting to know how annoying some of this stuff can be before you can really start to solve some of these problems. And even then, I don't know anybody who's really cracked it. I think if you ask even my good friends at the Rocket, they would say an awful lot of the stuff still comes in over email as PDFs or is taken over the phone. And like, I don't know anybody who's really figured it out, if they're being honest with you. And I don't know why. Hopefully you can tell me why.
Oh, $1 million question. I can give you my opinion. It's probably worth $2. So, I think we still are in a bit of a relationship business, but let's take it from a company perspective first. It's complex, right? So not every loan's a Fannie Freddie loan. So I would say the agencies do a good job of allowing you to use consumer permission data, right? Whether that's assets or income. There's all versions of this now, right? There's automated income directly through the agency, where they come up with their own calculation, whether it be off assets. There's pay stub OCR stuff. I mean, there's all sorts of different ways and vendors out there. So there's no shortage of avenues.
So let's say you're going to take the agency number for income. Mm-hmm. They have a number. It's $143,000 before taxes annually, or whatever. It's monthly. It's monthly.
You're talking about taxes. Like the asset scrape?
Yeah, well, no, asset scrape. Yeah. Right? So that person's in a competitive bidding war, though. And like, now it's time to try to document a little more income from maybe your side hustle in order to win the deal, right? But that's not what the GSE stuff is really. Yeah,
so it depends, right? It's the waterfall Nate and I always talked about, and I think that's a pretty industry standard term. So that revolves around complexity. So you have loan program complexity, which is for a long time, a lot of loan programs didn't accept any of this data. Okay, so whether I was selling it to a government loan or to a jumbo, you don't always know the loan type when it comes in the door. Well, okay, but what if I'm pulling that data up front? There's a cost I'm incurring. So I've incurred a cost for zero value. So, and then I've already permissioned the data from the consumer, and I have to turn around and ask them for their assets and pay stubs, even though they literally just gave you this data. So now they're concerned or they're confused. The reverse is, I don't ask for this data up front. I do find out it's a very clean GSE loan. And then I've got to go backwards and say, hey, will you click on all these links or do this? It works, but it's not great. It's just not a beautiful process, which I think Nate and I always envision that we really need it to be a beautiful process. Technology has so many amazing apps and platforms that are just phenomenal, but because not every program has adopted it, I think consumer hesitancy is very low now. I mean, it used to be a thing. I'm not as concerned about that. I think people permission their data left and right. So that's a little bit out the window. But then there's the cost issue, and then the waterfalling of how much data do you need, right? So there's this income source, there's another income source, and then at the end of the day, I'm asking for 3 different things from the consumer. They get confused pretty quick. And for our salespeople, they're just like, no, just let me do it the old way, because at least I know up front what I need to get, and I'm not going back to them 2 or 3 or 4 times, which is the irony that the tech is supposed to stop all of that.
John, bring us back to reality. If I take us too far down the this is never going to happen.
I'm 2 whiskeys in. I'm not going to bring you back anywhere. Let's go.
So, Patrick, the question that I was trying to articulate is, are we doing this because we've layered on? So we started with gross income, right? Whatever that is, give me the document that tells me your gross income. And then we've layered on so many variations on the theme instead of ever rethinking the holistic financial picture of that applicant. And so what we're really talking about here is, hey, we're stuck. We're stuck because we started with gross income, and then it was this type of income or this type of income. And then we added a rule about this, and we added a rule about this. And so now there's the waterfall you're talking about, which is the cost of pulling data from sources. But the only reason we have to pull data from 17 different sources is because over time, we've layered on requirements that actually might not be requirements, but because we started from a point of gross income on documentation, and then we said, oh, well, now we have to adjust for this, and now we have to adjust for this, and now we have to adjust for this. Is it right to say that there is a holistic picture that is different? Or are you saying, even with that, the complexity of everybody's different household is always going to be a problem?
Yeah, I mean, if I'm understanding correctly, I think what you're saying is, hey, is there an easier way, right? Is there an easier way to look at this data that is not the current model? I'd love to say yes. I think yes, that's true. But you are talking about decades of systems that are built around this model, and so it is going to be sort of a Band-Aid model. And remember, even if the GSEs want to do it, they still have to get SIFMA involved and the securities, right? And at the end of the day, they want due diligence, right? And their due diligence is what they know that they can run their historical models on, right? So you have this thing where it's like, if you really wanted to break it, I'm not saying I know the answer. I really don't. But do I think it can be broken? Sure. But how do people come up with their risk profiles? They usually look at historical data. So you're saying, hey, I don't really have all this historical data. I've got this new thing I want to do, and I want to break the mold, and I have no historical data for you to price this risk in. And so you'd have to do sort of a Herculean effort to compile all of that historical data, right? It's all possible. Who's going to take the work, right?
Well,
and
it's not just the work; it's like the fair lending lawsuits that.
Yeah. So yeah, I mean,
take a look at the credit report, right? Like the FICO score or the scores that the GSEs use for actual underwriting, those are based on decades worth of credit report data, I think is the point that you're making, right? And someone has looked at decades of credit report data and come up with a model. On the left-hand side is the probability that you'll default. And on the right-hand side is 20 variables that people have decided are the right variables based on statistical analysis or whatever. And that's been tested over decades and lots of lawsuits won and lost. And at the end of the day, this is the safe way to do lending. If you looked at the collection of someone's bank account and brokerage statements, you could do the same sort of thing. You could have you can have a model based on cash flow from someone's bank accounts, and on the left-hand side would be the probability that they're going to default. And on the right-hand side would be a bunch of variables that you came up with based on all the data you can see about the income that they have and the spending that they do and the investments that they have. And you could just as easily do the same sort of analysis, but that's not what people did in the 90s. People started with the credit bureaus in the 90s, and that's kind of where we are, right? And so if you wanted to forge the new path to be able to do it, then you'd have to, number one, be able to do all the analysis he was just talking about. And then number two, you'd have to defend it in court for decades to make sure that you're not systematically discriminating against anyone,
Yeah, I think
which
that's
we
a
don't
big
want to
deal.
do. Then all of that comes in. And so then you kind of get stuck with where we are again.
Poor Jeremy is like, he's such an optimist, you know, and you guys are really just, you're fucking tearing him down right now.
sorry, I don't mean to tear you down.
Let's build it. Let's build
Every
it
time I
back
talk
up.
to him, he walks
I
away
don't
with
mean
his
to
head
tear you
shaking.
down. I'm sorry.
I don't know that I feel torn down, John. I guess what I was going to say to you was like, well, then we're good. Based on what I just heard, this is the way it is. This is the way it's going to be. And so we can nibble around the edges, but the mortgage process is the mortgage process now. We're at 22 days. We're going to be at 22 days forever. And there's nothing else to do, right? I mean, that's...
Yeah, I mean, so I'll make a couple comments to maybe bring you back up, Jeremy, and I'd be curious to get you guys' thoughts on this. So I heard recently Bill Pulte and Scott Turner were getting together and saying, hey, it's crazy that we both run these massive guarantee shops and our rules are all different. Maybe we could figure out how to make them a little bit more similar. And so one of the complexities you guys noted was like some of the difference of different programs kind of creates some challenges. And so there are some things that can be done just in terms of aligning different programs that I think would be super helpful. So that's one comment, but let me make one other comment before you guys respond, which is there was one other time in the history of the mortgage industry when we figured out how to make it a lot easier, which was like 2002, when we're like, I've got a borrower who's a doctor, he's got a 780 FICO score. I'm not going to go through the problems of documenting all of this bullshit, because at the end of the day, every single model I've personally ever looked at, if you tell it there's a 780 credit score, you can't tell it anything. You can give it 100 DTI and it will still give you an approve. Nate, I know you know you've seen DU models, right? I mean, all of these models will give
Not about 100 DTI, but okay. Like, I see your point, right? I mean,
do 110.
I believe you. I don't
unless you create a different
VA's
gradient.
fundamentally different model.
But
I believe you.
But anyway, my point is, like, at some point, there's no need to document or fix the risks. And we figured that out in the early 2000s. And then, unfortunately, that led to systematic misrepresentation and lying about stated. And then we got to this point where it was like, we're not doing that again. So we're going to, every single rule that might need to apply is going to apply every time. And I think, not to say that looking back at history makes me optimistic, because that didn't lead to a great place, but like this idea that we're documenting stuff that we don't need to document, because at the end of the day, most loans are so far into the approval range of underwriting that it doesn't really matter. I mean, it doesn't
That's
matter.
a really good point. I mean, but aside from, the mortgage industry would work a lot better if everybody was a doctor with a 780 FICO score. I mean, I think we can all agree on that.
Oh.
Right.
I don't know. We'd all be healthier, I suppose.
Yeah. I mean, I think you have a really good point.
I mean, I think the average FICO right now for Fannie Mae acquisitions is well into the 700s, 740, 750. I mean,
well, I mean, you can look at it the other way. The FICO that is most appealing to the GSE is around a 700 from a pure profit perspective, right? So they price that loan up to the consumer from an LLPA perspective, right? It gets embedded in the rate or something. But when it comes from a like runoff perspective, the duration of the loan is much higher on that FICO for some myriad of reasons I'm not familiar with. So in a weird way, they're ideal from a profit motive perspective is like a 700 FICO.
well, I mean, the GSEs do a lot of cross-subsidizing. It's the lowest risk loans that have the highest amount of return for them versus anything that gets riskier goes down. But for the capital markets investor, and maybe that was the point you're making, is like, hey, if you're going to pool a bunch of loans, give me those sub 700.
Yes, exactly.
And that'll. But from a Fannie Mae perspective, they certainly prefer to get a high credit score borrower. But again, I don't know where to draw the line, and maybe I'm just thinking too far out there with like, hey, if you're a 720 plus, prove that you're at least a 50 DTI, and then we can move on, versus prove every ounce of income that you have.
Well, I mean, you don't have to prove every ounce of income, right? So there's no requirement to show me everything. It's just show me enough. And so, the best companies, and most companies know this now, that's all they do, right? We have, when we underwrite a loan, we have the minimum standards, right? Which is don't overload the borrower with documentation. What do you need to get the loan approved and get it through? And like you said, the vast majority of loans are amazing. I don't need any additional documentation. Right when you open that file, not that you're opening a file anymore, old terminology. So we look at that. We look for the least amount of documentation possible, the least amount of income to document. So in a way, these platforms to automate the information, they're great. It's just they don't work across the board. And when you're incurring all these costs running them and they have zero value for X percent of loans, it's just tough, right? It's like, man, what's my methodology? I mean, really the magic in today's environment, let's assume you don't change anything fundamentally. The magic is probably something I would guess Rocket does well is what is your flow of a loan? When does it pivot to A and pivot to B and pivot to C based on that documentation as it comes in and make the path the easiest for the consumer? So is this, and I don't mean A in credit quality, it's A in documentation or B in documentation or C. And and don't mess around and jump across and don't take everything up front. And so if you can kind of master that, you can create a really efficient, clean process, but you have to, it's more complicated than it sounds.
It's like best X pricing, but for best X documentation standards. That's what happens. It is. It's like you see once I have two investor standards met, or even one in the case of the GSEs, that is two automatically, we're done. Let's go. But to your point earlier, I think both your points, we actually then have no idea the risk profile of most GSE loans. We have no idea. All we know is they cross the threshold of being good. We have nothing visibility-wise beyond that because every originator, to your point, Rocket included, is doing exactly what you said, getting to a certain point and stopping. Yeah. So we really have no idea beyond that.
Well, that's why we can approve a 100 DTI loan, because DTI as a variable is terribly recorded and documented. It's just very inaccurate. Same thing with reserves, even worse. And if you're not recording the data appropriately, it's not going to be predictive. And that's, but we have a lot of it. Going way back.
Well, and I think there's a psychology piece, right? Can you imagine selling a pool of loans with an average DTI of 80? I think just psychologically someone is going to lose their mind and not, even though you can sit there and show the data, they're going to struggle, right? Or the price is going to get severely impacted. But I get it, right?
Do you get a sense that working with specifically non-agency investors, do you get a sense that there just isn't a lot of visibility across the investor to the due diligence company, the rating agency, all the way through to your originators? Because what you just said is actually somewhat just about data visibility and data transparency from what you know about the loan to what ends up being visible to the people buying it.
Yeah, I've never had the conversation with those that buy it. I think they somewhat think about it like we do, which is, I guess if you're going non-agency, I think they have an understanding of what we're talking about, right? So if they're not agency, they're saying, listen, I know these loans are better. I'll do the 55 or the 60 DTI. Just give me these other buckets that are, higher, whether it be FICO or assets or reserves. And I think they've somewhat mastered that and said, hey, they're going to drop this in as a 60, but odds are either the risk profile is super low because of our reserves, or there's more income they're just not documenting. There's some percentage. So they probably have some of that in their analytics. That's probably a good way to think about it.
All right, guys, let's take a break. We're going to come back and talk about the future and all sorts of things like AI and cool stuff like that.
Didn't we just decide there was no future? It was just exactly the same.
AI is going to fix it.
Okay, well, that does it for this episode.
That's like when Nate and I got started, everything was blockchain. And Nate walks in my office. He's like, if I hear this word one more time, I'm going to lose my mind. And I don't hear it anymore. So Nate was right.
Well, we're going to talk about it in the next part of this episode.
All right, fair enough.
All right.
Welcome back to Housing Insiders. We're talking with Patrick Gardner of Vellum Mortgage and Nate Denherter of Ardley Technologies, and we're not talking about blockchain. We are talking about AI, though.
I like blockchain.
It's coming back.
It's
coming back as a due diligence tool.
Yeah, that's right.
That's where it's coming back.
Right.
We're going to do due diligence on the data.
Yeah. We can talk crypto.
Interesting.
Or we can talk crypto. That's right. Crypto mortgages. That's the next thing.
Yeah.
Is Ardley ready for that?
Yeah, if you want to do a crypto mortgage, call me. We'll
That's right.
figure it out.
Yeah.
All right.
We'll figure it out for you. Yeah.
There we go. So I think as we think about what Patrick said, and he said, you have a high degree of very specific rules that need to be organized against the data as it exists. That sounds like a problem for AI. A high degree of rule sets, rules engines that run against documentation data standards and run in real time and tell you the outcome. So how is that not an AI problem?
Well, I think it's a great problem for AI as long as you convince the people who are risking their own capital that your AI got it right.
Can
But without the
can we go backwards?
Did it get it right? That's
This
the
is-
question.
This is my number one question I ask everyone if we're talking about AI. Define it, because
what are we talking about?
well, the definition of AI for different people or different groups are different. So
That's a really good point. Like,
so
yeah.
yeah. So I simplify and I just say, for me, AI is anything that uses a large language model right now, because anything that OCRs or has RPA.
Or before that, an expert system, which is what
A
Fannie
business
and Freddie
business
put in,
rules
yeah,
system.
any
Right?
business
That's been
rule
around
system.
for a long time.
But you have
I
to
would- I
also
wouldn't-
separate it from machine learning and
machine learning.
robotic process automation, which
Yep.
are all versions of sort
Yeah,
of
so-
codifying rule sets.
But I think what you mean more is like ChatGPT or whatever with the large language. Is that what you're talking about
that's
more
what everyone
lately?
means when they're talking about yes.
So let's actually play the thought experiment out. You get your own iteration of a large language model that you fed your product and pricing into, and let's control for the data coming in has already been absorbed, cleaned, ready by some other maybe AI, maybe not version. So the consumer's data is now coming into that environment accurate, right? We pulled it in, however we pulled it in. And now you're bouncing it against a really strict rule set for standards of ranges across all these different, I think, data fields. And the outcome has to be, how many of those does it apply to, right? Because you were talking about green check marks, Patrick. You were like, it goes for this program, but not this program, but it does for this, but it doesn't for this. So we're pulling in the data, we're applying it to all these different programs, and then we're getting green check marks or red X's for which ones it applies to. That, to me, feels like what we were talking about.
And maybe it is. I don't know if you need a large language model for that. I mean, I think what you're talking about is I have a grid of, data scientists would call it maybe a vector of data that is what it is, and then you can run a system of rules against it to ask the questions that you're trying to ask. I'm not sure that a large language model with what data scientists might call a Markov chain of probability predictions is the right tool for what you just described.
Yeah. So a mutual colleague of ours, Steve Holden, Nate, who I know you know, he's been working on AI issues at Fannie Mae, just sort of thinking through it and has become an expert. He did a great LinkedIn post about what I'm going to mention.
Yeah. Shout out to Steve.
I mean, really a brilliant way of sort of laying out what AI can do is like, you can use robotic process automation if you have a series of steps that you want to automate, and there's a limited enough set of rules that you can sort of program them. But if any of those steps require some form of judgment, that's when you can bring AI in, and AI can make that better. And I sort of interpret judgment in a couple different ways. One where it's like you've got to judge some non-rule based types of things. That's a little more esoteric, I think harder to understand. But the other way, and I think Bob Walters said this well on the episode he was on with us, was the permutations of possibilities in the selling. So it's infinite, right? And so being able to codify all of those various combinations is really hard, whereas AI can sort of just go to the guide and figure it out pretty quickly and sort of use judgment in that way. So if you think about AI in those terms, there may be moments in the process, as you've kind of decomposed it, Patrick, where you say like, well, this is really hard to just codify in a set of rules. And if I do, I have to simplify it. It's not perfect. Where if I deploy AI, is this going to be a high documentation loan or a medium or a low? Like maybe AI is able to do that better than a system of rules that you can program. Maybe.
I think it's a good point. In the same way that a human underwriter is maybe using their judgment. I mean, the way that these AI models really work, it's a system of, the point of a Markov chain is the probability of the thing that happened before affects the probability of the thing that comes next. So it's making a judgment if you want to say that, okay, well, this token affected the next one and the next one. I think, when it comes down to it, I think I still wonder if you're someone in Patrick's position who's risking their own capital, and Patrick doesn't loan his own capital, he uses a warehouse line, but the people who loan him the warehouse line have some questions if he starts to have too many loans that come back.
I'm indirectly signed,
Yeah.
right?
But my point is, get somebody who's risking their own capital to trust the judgment of the thing in the Markov chain that's decided that this person's gift letter is legitimate, or whatever
Let
it
me
is.
ask you a question that came up today. So I was talking to somebody. Gift letter is a good example, I think. This one came up actually in a conversation today, John, where somebody was telling me that a human underwriter is going to have a different take on the mileage to a job than either the guide or AI would. And that actually is protecting us as lenders, because that's a subjective decision. And I was like, aren't we adding rules now that sort of don't exist and so I think what I'm trying to say to John's point is, if we actually just read the guide as it stands, we've added all this other context because we're afraid, to Nate's point, of like what someone might say retroactively about my decision on the data. But the reality is, if you feed the guide in, it's going to say,
Well,
you have to have reasonable.
No. So I'm going to disagree. So this
I'm
is
glad
fine.
we have
You know
someone
who we
who's
need?
risking his own capital
Yeah.
here.
Yeah.
This
Agreed.
is really a good episode, guys.
This is funny. We need Mike here. Mike, you. So this is funny because he always says, underwriting. He can't stand someone that says underwriting is an art and not a science. I actually disagree, and here's why I disagree. I don't underwrite loans. I have some knowledge, but at the end of the day, do we get a number of loans that are Fannie Mae eligible loans that have been turned down by other lenders that come on our desk and where we say, absolutely, this makes total sense. We use our breadth of experience and knowledge of selling to Fannie Mae to know that that's the interpretation of that guideline, right? And so there is an art, right? There's an art to the knowledge. Now, in line with AI, we are building, and we have built, sort of a model that deeply understands all the guidelines. And that's trickier than I think anyone thought initially. But we have built two models exactly side by side, meaning the data fed in is perfectly identical, but the prompts are fundamentally different. And one is a guideline expert and one is an underwriter. So one says, will you approve this loan? The other one says, find the guideline for me. It's really fascinating how different it responds. And so, when you get into AI, I have the same code for the most part, the same source data, but my prompt is fundamentally different. All right, so that's an art form right there. But at the end of the day, I still think there's such a human element. I think AI, where we are leveraging it is phenomenal at parsing through enormous volumes of information, right? It does a phenomenal job for us. So we look at the ROI as, we don't really need an underwriting help desk anymore. We don't need, the questions that come into the myriad of desks we have are going to be virtually obsolete in our eyes, because we basically fed those through and they come out great. All right, that's a bit of ROI, but that's not really what we're looking for out of AI. I think it's going to be more layered on top of business rules and RPA, and you're going to use the AI just to kind of chat with your system. And then the question is, do you turn it on for the consumer? I'm not there yet. I don't, I know there are lenders out there that are big on AI facing the consumer. I don't know if it's a generational thing, or I just don't feel that that's the best use case.
A licensing thing.
Well, so there is that, right? There's a licensing thing.
Does this thing have a license to talk to this guy about rates?
Yeah. So certain states are, if you do anything that crosses the line, that has to be a license. So you risk your company's license, but you can put the guardrails on. But that's just not where I see a big ROI, because it feels weird. The handoff feels weird to the consumer when using.
Have you seen this new Tilly Norwood AI actress that's got?
I've heard.
I would rather talk to her than any of your loan officers, to be honest with you. So, I'm making that as a joke, but I want to say something that Mike, you said, I think, when he was on our episode, which was, I would rather be in a taxi driven by a robot than in a taxi driven by a human, which is fascinating. I haven't really had to face that decision, but like at the end of the day, like, yeah, I kind of imagine at some point you have to believe that the data and the taxi is going to be safer than an imperfect human being, which is why I think it's a little funny. And Jeremy asked the questions like, who's going to be willing to take the risk on the basis of what a computer says? It's like, you're willing to take the risk on the basis of whatever like Joe underwriter says over
100%.
here. But I mean, but again, like why? And let me give one other example before like loan underwriting, which is like, wouldn't you rather have an appraisal done by an AI/drone combination where it has photographs of your home, it has all the data of all the comps and all the photographs? Like,
you're baiting me now, John.
Isn't that
you know that I worked on collateral?
I know. I'm trying to bait you a little bit here, but I also just had dinner with Keenan Chen, a previous guest of ours as well. And I mean, I would much more trust an AI appraisal than I would a human appraisal.
Yeah, 100%.
With that data as the backdrop.
Yeah, and I think the end of what I was saying is it's a percentage, right? So absolutely, if I think you can get really comfortable with these models where if they are giving you an approval, you just let that loan go. But if it gives you a decline, you do not. You then put that in the hands of a human, right? So it's just off-ramping, so you get an enormous amount of speed. But I think if you said, hey, it's all data, I think things like disparate impact would skyrocket, right? I think you would actually have you would have greater problems because complicated income streams, how does it know what a relevant 2-year history is? Does it really know that job is in line with another job, right? How does it know to read a letter of explanation?
How does a human know?
Because we can go online and deeply research what these companies are, and we can make phone calls and dig in. I mean, we actually do have to still do that, right? Like we still do verbal verifications of employment, and we will call, and sometimes we have to ask some pointed questions. Now, the point is that is a smaller and smaller and smaller percentage. And I fundamentally agree that AI is huge and will seismically shift kind of everything that we do, but it's not a one box fits all. I think for a while it's no different than the permission data. So it was a slow incremental process where people use verification of asset, then verification of income, but it's grown and grown and grown, and AI's adoption will grow. It'll grow faster. AI is just moving at such pace though. It's hard to keep up. And as an example, we switched models mid-flow with what we were doing because we tested them all, and then we struggled along and it was harder, and then we flipped models midway through and got better output even though it was worse 6 months before. And so that's tough.
Switching AI models, you mean like Claude, ChatGPT?
Right. And so that's tough to develop. Right. That's hard for a company, particularly a company our size. Big companies, they can take those risks. Right. For us, it's much harder. And then if you outsource or you get a third party vendor, you're stuck with how they think about it. Right. That's always the challenge. You have to conform to their operational.
How much does the conforming to the vendor affect your decision making? So you're talking about in the context of AI, but for IMBs, it is who my POS is or who my LOS is, who my PBE is. And it feels like a lot of mid-size IMBs are captive to their vendor.
Oh, the vendors can be trusted. They're excellent. They do a great job.
Yeah.
End of podcast.
Yeah. So actually, this is a good point to go back to it. I didn't love that whole concept, which is one of the reasons why I begged Nate to quit Fannie and come over. Because remember, he was building a point of sale, and I said, hey, let's do this together. I said, I can teach you this side of it, and you know the tech better than I do. That would be the reason for it. The other issue, which I completely understand, is these softwares are always trying to increase their value prop. right? So they want to either provide more to increase their cost or provide more to capture more market share. But the problem is there's so many softwares that they overlap. And so I have too much of things. And I want to be able to a la carte pieces. And so if someone could really allow me to a la carte their software, hey, let me strip out A and B, and I'm going to take C and D from company 2, I would actually probably pay more for those little individual pieces than having to block off this part of the system, right? Like CRM is one where everyone's creeping into the CRM, right? Their platforms are reaching, even PPEs, which were historically just pricing engines. Nope, not anymore. And so that's hard because, I really have to like train people out of using that aspect of the software, and I'm getting upcharged for it. So yeah, unless you want to build your own. So one of the strategies we had early on was we would adopt very young companies. So we were one of the first to go on now obsolete Compass PPE, phenomenal product and pricing engine. And so they didn't have a ton of clients. They would sit with us, they would listen, we could talk through new ideas. It was just awesome. And it was the exact same way I felt with Ardley, right? Nate would sit down and we would go through it, and it felt nimble. It felt like we had a say. There's no way, Vellum's a rounding error for most of these people, right? So we're not doing that with larger companies. They're just like, sign the contract, here's your software, and it works, which is fine. I understand that model, but that's harder and harder because as the industry has gone through, the post-COVID trouble, there aren't a whole lot of small companies willing to really be super nimble, right? It's not cost effective for them. And I'm sympathetic to that. So yeah, we are beholden to that. We just have to be super smart about tech adoption, and we have to be super smart about tech implementation. And so that's a skill in and of itself.
What's the most valuable piece of tech that you've adopted at Vellum?
I've never even thought about that.
Nate has a podcast career
after this. Next week on Housing Insiders, yeah. Nate guest host.
I should know that. Yeah, actually, you want to know what the most valuable piece? This is going to be terrible.
Yeah, don't say Encompass.
No, Slack.
No,
I'm serious. So
that's the most valuable thing at my company too.
No,
terrible.
Seriously,
it makes sense.
No, if totally you think this through,
we're so addicted to Slack, we could never stop.
Right?
Ever.
So think about it, but it depends on how you implement it, right? So it sounds like such a shitty thing, like, oh, Slack. I'm like, what? It's a DMing system, with channels.
It seriously is. It's AOL Instant Messenger.
Yeah,
but
right.
Like nicer version of it.
You've got mail. But how you implement it can be beneficial. So even Slack has creep. They're doing all this stuff where I'm like, I just don't care about this shit. Like, it's too much.
Yeah, they got AI in there now, and I'm like, stop summarizing this channel. Do not care.
But so I am fundamentally a hater of email, right? It's just, you cannot, the volume of emails you get, it is impossible to prioritize off the subject line. So then you have to open it to figure out whether it's a priority or not. And you're getting external emails and internal emails. And is it a group thread? And are you on it? Emails are just absolutely a necessary evil, but they are wonderful, magnificently inefficient. So we look at it as anything internal has to be on Slack.
We do the same thing.
Know.
It's the same thing here.
Talk to each other.
I can't remember the last time I emailed.
The only time we'll email if it's something really like robust, right? And it's like, hey, I need everyone to read this, and I don't want everyone commenting on the channel, and it's got an attachment, or there are times when it fundamentally makes sense, or if you just want to quickly forward something. But generally speaking, we all communicate on Slack. So when I know that dings, and you can control your notifications, right? So we have silly channels, mute those, right? They're not going to interrupt your day, and you can look at those when you have time. And then we have serious channels, and you can prioritize that stuff so that you're not interrupted all day long and your concentration isn't wrecked. And that typically a Slack is a quick question, right? It's a quick, hey, let me do that. The efficiency we get out of that over the inefficiency of email is shocking, right? What a simple little, we've got all these things, right? We've got point of sale systems, loan origination systems. We've got CRMs, and none of those probably carry the value that something like Slack has.
And just a point of order, you're not a servicer, so you haven't adopted the
Yeah,
Ardley
so-
system. Is
so-
that right?
so to be
You haven't
fair,
adopted
yes,
it.
we're
I
a-
just
We're
just
a
want to
small-
be clear
we're a
on that with
small
everybody.
IMB,
Yeah,
right?
small
Let's-
IMB, so no
you know,
servicing
there's-
portfolio.
There's lots of companies that have built their own platforms and done all these wonderful things that I'm sure have phenomenal value. But as an IMB, right, we're mostly going to outsource. And that is the sad answer for you.
And your answer was Slack as well? So you asked the question, but then you agreed that Slack is the most valuable thing in your...
Who's the CEO of Slack now? Or it's Salesforce,
They-
right?
Salesforce bought it.
Yeah.
Oh.
It really is. We run the whole damn company off Slack.
Yeah.
I think
Sure.
I'm
But I
always
can-
surprised
But I
when com-
connect to other companies. So like,
Yeah,
Mike,
well, we're
Mike
connected.
Q,
He-
that's- I connect to Ardley.
Yep.
Yeah,
I
we're
connect to
connected to
Mike
Slack.
Q.
No, that's a
I-
good example.
Built
Yeah.
Rewards is connected to Ardley on Slack.
Yeah.
That's like her.
Yeah.
One time our support team asked you to start emailing.
Yeah, we're like, fuck no.
You did. You said we went to lunch and you were like,
Email?
we had to have a whole conversation about it. You were like, I will never.
Yeah.
I was like, okay, don't do it.
We can't.
Yeah, that's true.
That's amazing.
That's actually a sad reality if you really think about it. Like, if you are listening to this conversation, you should say, hold on. There's got to be a major opportunity
I think it's-
if IMBs and a software provider are saying Slack. That's
I think
terrible.
it's so I would.
I think
so-
it's great because
so it is
everybody
funny,
listening can now...
you know, right? It's
Yes.
about communication, right? And efficiency.
That's
right?
right.
Please
I mean,
still buy my product though.
Yeah.
I've talked to So I think a lot of us know the group SafeRate that's been working on this sort of AI point of sale system.
Yeah.
And I'm always like they keep saying like, oh, you can now do like it on Snapchat or you can do, but like I just forget that how many people just run their community. Like we use Slack because it's like a dorky professional thing, but like I think it's just like Slack's replaced emails. For most people, text messaging has replaced the phone
That's
call.
true. Most places in the world, WhatsApp is the main.
What's
That's where they do everything. Calls, you name it. They
Yeah.
buy a phone for the hardware only. They're
Yeah.
doing everything on WhatsApp.
Yeah. And to be able to take an application purely through text message, it seemed weird to me, but I'm starting to see these interesting companies come out. Like we've been demoing a lot of these sort of text interfacing types of things that are using AI to power it. And it's actually really, it's no longer just a communication. It's like a surfacing things you can actually do or links you can click, you know what I mean? It's like a more engaged type of platform. And
Yeah, and then we have to, and then you get into the legal aspects around all of that, right? You have to be careful when you're texting and all these things. There's a regulatory rule for every platform that you use, so you've got to alter. So texting forever was very difficult for us, and I can't remember the word, TCPA or something like that, and so it made it complicated because of how we had to get authorization. So no company wanted to do it, and everyone knows text is phenomenally better. So for a long time, we wanted to do it, but we didn't want to go through the hassle of the regulatory environment. So there's pieces like that still exist where there's just a hurdle there that's frustrating.
We have a few minutes left, so we'll put Nate on the spot first. Patrick, you'll have a little time as Nate answers to get ready. You have to go first because you're the technologist. You know how to code. I think that's what we heard earlier. You know how to code.
I do know.
So the question is, if you weren't working on Ardley and you were recommending, we have founders that listen, we have entrepreneurs or wannabe entrepreneurs who listen, what would you think is the business that you would want to see somebody working on? What's the problem you'd want to see somebody working on in this industry that you'd say, if I wasn't doing Ardley, somebody should be doing this. I would be doing this or somebody should. What's that business that you wish existed?
I would really love to see somebody replace credit scoring with something for cash flow. I think that makes a whole lot more sense. I mean, we can see how you have managed your finances over the course of the last however many years. I really think you could make a very robust model that would be every bit as predictive of default, but default in other contexts. People forget that FICO is designed around credit cards. On the left-hand side of that model is, will you default on your credit card in the next 90 days? Year, whatever it is. But whatever it is. But the point is,
it is credit card based.
That's the question.
Yeah.
And I really think it would be a deep, wide ocean of really, really interesting things that you could learn about people, and you could really dig into approving the right people and approving all kinds of people who are very responsible with their finances, that it's kind of invisible right now in some ways. I think about communities that are underserved who are very conservative with their finances, but they don't use credit in a way that looks good in the models. I think that would be an incredibly fascinating business for somebody to go in. And unfortunately, you only need about 45 years worth of capital so you can convince all the regulators and all the lenders and the capital markets and everything to come up with the NATE score. That's what it should be called, because I'm planting a flag right here. But anyway, I think that would be the most fascinating.
It's far more defensible. It's, you know, like you get rejected for a Fannie Mae loan because you're a 619 FICO versus a 620. It makes no sense.
Makes no sense.
But when you can start saying, well, it's because you don't have these $10 extra a month to cover your mortgage payment, it just,
I think that to me,
so much more sensible.
I just have the statistics could prove me wrong, by the way. I mean, there's math that would help me win or lose, but I think it would be very interesting to look at that. And you know, I don't know anybody's going to pull it off anytime real soon, but, and you know, shout out to Mike Yu, who was willing to forge the path on LOS adoption, which is a difficult enough timeline. I think this would be even more difficult, but that would be pretty incredible.
Patrick, your turn.
Well, I was just gonna postscript to him. I mean, if you all look at VA doesn't really have a DTI requirement. It's residual income. So it's not an asset pull, it's not cash flow, but it is really just how much income do you have left over every month? That's how we look at this, which is a very different model. I can look at this question a couple of ways. So what would I want to do? Like to sort of fill my bucket, for lack of a better word.
No, we don't care
so
about
I want to be, no,
just
well, that's what you're kidding. So listen, you invited me. So I think the biggest issue, and I have no concept the solution, but that is what I love about it, right? It would be a mega challenge, is we have such a massive affordability issue. And I don't want to hear, oh, if we just lower interest rates. I don't want to hear, oh, if housing prices just would go down. That's just not going to happen. And if you do one, you're not going to get the other. So when rates drop, those prices are stable or going up. So we may have prices coming down in most areas right now, but it's because rates went up. So they're inversely related. You have to attack this fundamentally different. And John and I have talked about this a bunch, and he does great work with this stuff. And I love listening to those companies, but I would 100% get involved there and find different ways to tackle homeownership. We are so stuck in how we do things, how we've always done things, what homeownership means to us culturally, what it means to us as a country. And I think that's changing, like generationally. The younger generation is really fascinating that, they would both share their home, they would share their lot, right? So they would build 3 or 4 homes. They live in that style. That's not, Nate and I's generation as much, and particularly not older.
You're older than me. Hold on. Don't lump me
We
in.
found out earlier he's younger.
Wait, how old are you?
I think I'm like 30, 35, something.
Is that what you think?
47. Sorry, I didn't mean to cut you off. You were
No.
You were doing great. Please.
No,
continue.
He was on a roll.
I'm sorry. I'm so sorry.
I was, but like 100%. Like you have to have such a group of people invested to work on that, and I can't move the needle. Like Vellum's an IMB. We don't create that. We don't create the product. We sell our product. So there has to be a fundamental shift in housing. It has historically been, the source of wealth creation for the middle class, and that's just not happening. And that's going to create enormous problems down the road for us.
Can't agree with you more. It's kind of the reason for the show. Patrick, Nate, thank you guys so much for everything that you guys have done in the industry, the help that you've provided me professionally over the years, and for being on this episode. One little bit of good news was that, and I consider good news just because we've been advocating for the GSEs to get involved in construction lending. And sure enough, the president tweeted that, he compared the builders to OPEC, which was a little strange and interesting. But then he said, Fannie and Freddie are going to step in and help finance new construction, which, again, something that we thought would be a great idea. We've talked about it on the show before, so it's great to see that out. So
is tweet policy now?
Well,
I guess it starts us down the road. I don't know.
Are we going to get into politics?
Yeah,
all right, that does it for
politics and
we'll
religion.
wrap on that.
that does it for this episode. All right. Thank you, guys. By the way, listeners, we'd love to hear from you. Any comments on this episode, please send them to podcast@thehousinginsiders.com. And if you like what you hear, we always ask that you please leave us a review for the show.
And hit subscribe so that more of our episodes find your feed. Thank you, Keenan Chen, for the music. Join us again next time.